Good afternoon, everyone. Quick look here at the closing bells, and it was a market sell-off once again, pretty much across the board. The Dow was down by over 700 points, but did close off the lows of the day. That's important. But the tech-heavy NASD is really where the story continues to be, which is pressure on those higher multiple valuations, those go-go growth stocks that have really helped move the market so high. They were under pressure once again. The NASDAQ closed down by 2.1%. It is now 10% off the record highs and, in fact, in negative territory on a year-to-date basis. The concern continues to be the backup in bond yields, that U.S. 10-year yield rising through that 1.56% level. There was a midday spike today. That is when we heard in a public forum from Fed Chair Powell not providing commentary that the market wanted to hear about the tools that the U.S. Federal Reserve has to keep those longer rates lower. Now, why is that important? It's important because you want to make sure that the financial conditions are easy in terms of borrowing and lending and not seeing a tightening in the financial conditions. The concern, of course, has been that the Federal Reserve can't control what the market's going to do, and that's pretty much what we're seeing today. We'll see if we hear more from Fed Chair Powell, but for right now, the market is really anticipating inflation. Why is that occurring? Well, you're certainly seeing the price of oil move higher. We'll get to that in just one second. But also, of course, the reopening looks to be maybe accelerating. You've also got Congress potentially passing somewhere close to a $1.9 trillion COVID relief package. What does that mean? That means that the economy could, in fact, accelerate, which means we could see inflation. And that's why the fixed income market is moving ahead of all of that. Now, they could be wrong, and the Fed could step in and do some type of operation twist or, buy the long bonds, put some downward pressure on the longer term yield, which would flatten the curve a little bit, make sure that the monetary infrastructure is easy in terms of lending, keep those rates lower for longer. But we have yet to see that. So that is why you are seeing this pickup in the yield and inflation concerns, and therefore selling of those tech growth names. So what was working today, of course, though, was energy. Interesting here, of course, oil spiking over 4%. This is on news, of course, that the OPEC Plus is not changing their production levels. And of course, that at a time, so they're not increasing the supply, that at a time when perhaps there will be that more accelerated reopening, there's a concern on the supply front. So energy on both sides of the border was the sector to own. And again, if you haven't seen my interview with Rafi Talmazian, please do go to my YouTube channel, Catherine Murray Media and Markets, and you'll find some good ideas and also his thoughts and in terms of why we might see that supply squeeze in oil. So take a look at that for sure. Away from that, I would just highlight as well that when we take a look at the TSX, it was down by 1.1%. We did see some pressure in the healthcare sector, which of course is represented by cannabis companies. They were down by about 6 to 8%. Tech was lower. Industrials were lower. If you own the rail companies here in Canada, they were down by about 2% on average. But of course, the best performing sector was energy. Again, take a look at that interview with Rafi Talmazian. Financials fared okay. They were down by about 0.7%. So financials, banks in particular, do like a rising rate environment. So that was a better place to be, a relative outperformer, even though they were in negative territory. And away from that, from a headline perspective here in Canada, the chief trade negotiator indicated that Canada could be left out of Biden's $2 trillion infrastructure plan. So think about that as we think about the economy. Speaking of which, we'll get the U.S. employment data tomorrow. Economists are looking for 175,000 to 200,000 jobs created. We'll see where that number comes in. And here in Canada, our labor productivity fell 2% in the fourth quarter. That is the worst performance or the largest number we've seen since 1986. Tomorrow we'll get the trade balance, so that's something to watch as well. I will leave it there. We're obviously keeping our eyes on the rate environment. And speaking of which, I'll send another item out on this, but I have asked Barry Allen to join me tomorrow, veteran fixed income investor, to put some perspective around what's going on in the fixed income market. So I'll bring that to you as well. Thanks.